This is honestly the number one question I am getting right now, and the answer is yes, but you have to be very careful, because the internet is leaving out the most important details. For the last 40 years, the rule was simple. If you bought a car for personal use, the interest you paid to the bank was dead money. You could deduct mortgage interest and student loan interest, but car loans were completely off the table. That changed with the major tax reform passed for the 2025 tax year. They introduced what is called an above-the-line deduction for qualified vehicle interest. This is huge because above the line means you do not have to itemize. You can take the standard deduction, which is already massive, and still stack this car loan deduction on top of it. But here is where people are going to mess up and get audited. First, it has to be a brand new car. If you bought a used car, even if it was new to you, it does not count. Second, and this is the big one, the car must have its final assembly in the United States. It is the same strict rule they used for the EV credits. So if you bought a luxury SUV that was built in Germany or Japan, you are likely out of luck even if it is brand new. The deduction is capped at $10,000 of interest per year, which is actually a lot given how high rates were in 2025. However, if you make over $100,000 as a single filer, or $200,000 as a married couple, the benefit starts to phase out and eventually disappears. So here is your action plan. Do not just look at your bank statements. You need to keep an eye out for a specific tax form called the 1098 VLI or a year-end statement from your lender that specifically lists qualified interest. If you do not have that document, do not try to guess the number on your tax return because the IRS is matching VIN numbers this year. If you have the right car and the right form, though, this could literally add hundreds or even $1,000 to your refund. So it is definitely worth double-checking your glove box or your email for that form.